Hi, it's Grant Abbott. I'm a director of I Love SMSF and the author of the Guru's Guide to Self-Managed Super Funds. So hopefully most of you got a copy of this book. Unbelievably, post-budget, this book needs a little bit of updating, but certainly we'll do that by the time we get around to the 1st of July 2019, when the family SMSF really comes into force. But at this present point in time, make sure you get a copy of the book and you listen to the strategies. Which really takes me on to the first point is, why are you here? Why are you listening to me? There's plenty of information around the budget changes, particularly around super. You can get that from the AFR or the Sydney Morning Herald or whatever your local paper is. You can listen to Sky News or Koshi on Channel 7. More importantly, for those in SMSFs, you can get some industry commentators talking about issues, both the ups and the downs of it. But really, in fact, you could have listened to me last night. I tweeted out a whole lot of my first glance ideas from looking through budget paper number 2. But at the end of the day, you're here listening to me for one thing and one thing only. And that is strategy. At the end of the day, our value to our client and our customer, the value to ourselves, is our intellectual capital. Without strategy, really, we have nothing. If we rely on the vicissitudes of the markets and put ourselves out as an investment strategist, then when the markets go down, and they may do in 5 months, 6 months, 1 year, 2 years, but when they go down, our clients will start to come hunting. And particularly if you're dealing in self-managed superannuation funds, Section 55(1) of the SIS Act, if you've recommended or made an investment that doesn't correlate with the trust deed or the investment strategy, members of the fund and also the trustee can come and recoup on a strict liability basis, which means virtually it's a no-brainer for them to win, to recoup all their losses. And that means not only losses from any investments, but potentially what they would have earned if their investment had been in a balanced fund. And there's a lot of cases around that. You can have a look at, for example, Irving and Dunstan. The second one, of course, knocking on the door, and there was in the budget, there was certainly monies put aside for the introduction of the Australian Financial Complaints Authority. Now that starts on the 1st of November 2018 and should be scaring everyone who's an authorised representative or a licensee, an Australian Financial Services licensee. Effectively, an action can be taken, and this is a no-cost action, so anyone can take an action if the markets have fallen, and I would suggest that everyone should probably end up doing that. If the markets fall, they take an action under AFCA, no cost, and as a consequence of that, damages can be awarded of up to $500,000, so that's compensation, unless it's superannuation, where $1 million can effectively be awarded. So the Super Complaints Tribunal and the Financial Ombudsman and also the Credit Authority have effectively all been blended into this new AFCA regime. So something that's coming down the track, money's been put aside for it, so we've all got to be really careful about that. And if you're in self-managed super funds, you've got to look at the Tax Act, the Bankruptcy Act, you have to look at the SIS Act, you have to look at AFCA, even the Protection of Super. They've got a brand new set of measures that came in this morning, and before this session I was going through the legislation, also the explanatory memorandum, which really starts to hammer a nail, as I can see it. And the one thing I love about this budget is it really starts to smash the industry and retail funds. And what they're doing is, finally, this government is starting to do a nice gentle push into self-managed superannuation funds. How are they doing that? Well, first off, they're opening up the superannuation, the SMSF sphere, from the 1st of July 2019 to 6 members. So that means once we do that, Section 17A of the SIS Act is going to be changed and allowing us to have 6 members. Now for me, and this is pretty important, that starts to open up the possibilities. I was talking a couple of weeks ago when this measure was first announced by Kelly O'Dwyer, why hadn't there been a lot of family SMSFs set up to date? And I remember going back and first introducing that concept way back in 2004 when there was only $132 billion sitting inside self-managed super funds. In those days, if you had a look at it, we're really looking at the early start of the baby boom generation or the war generation who are using their monies and building into self-managed super funds. A lot of them are done extremely well, and you've seen it with some of your clients, $1.5 to $2, $3, $4 million sitting inside these funds. They've ridden the bull market up, and more importantly, inside these funds, they've been able to be in a pension mode where they're not paying any tax and getting those franking credits back as a tax refund. Now, fundamentally, that will change at some point in time. If the Labor government gets in, sorry, there you go, there's a bit of a Freudian slip there. If Labor gets into government next election, then effectively we're going to start to see a reduction in the ability of those tax refunds. The imputation credits can still be used by the fund, but effectively they won't be able to be refundable. And I've got a couple of strategies around that a little bit later on. But anyway, let's take it back. So we've got these the baby boomers, and we've also got the war generation in there. And as we've gone down the track, what's happened is people have started to die off, become mentally incapacitated, and now, believe it or not, 23% of self-managed super funds have one member, and that is so dumb. I mean, really, why would you have a one-member self-managed super fund? It might be okay, but surely there's children or someone else who can start to take their place inside that fund. Second one, most funds generally have got 2 members in them, and only 10% have 3 to 4 members. And it got me to thinking, why haven't we had family self-managed super funds today? And really it was because of the fact we could only have 4 members in the fund. And I'm thinking even in my parents' fund, we had myself and my brothers, but not all the family could be in there because there was 5 of us. Really, how many families only have 4? And I think that put a brake on it. And certainly, our clients don't understand self-managed super funds, and I think most of us would really see that. They tend to go to their accountants or their administrators, or more importantly, the financial planners, to start to get some context and understanding around self-managed super funds. Certainly there's a lot of DIY funds out there, but if you're running a DIY fund, you've just got to be really careful and make sure you do the right thing, because really it's a pretty tough ask to run one of these funds by yourself. You really need professional help in order to access that strategy. Now, from that perspective, getting back to that story about the family super, I believe because there's been that limitation, and most accountants and planners are aware that their clients have got 2, 3, 4 children, and it's an issue about which ones fit in. And so rather than make the decision of, well, let's tell the client and work out who shouldn't go in, or the client not wanting to, making a level playing field across their family, saying, well, I don't want John in because he's not allowed to. Effectively, that family self-managed super fund idea really never took off. Anyway, lo and behold, we're now in a position, and it was a real shock to me. It was certainly something when I was the chairman of the Australian SMSF Members Association. We pushed Canberra really hard for a few years ago to increase that membership up to 6 or even more, provided it was family. And now we look at 2020, in fact, we're around just touched over $700 billion of assets. So by 2020, we're going to have $850 billion sitting in self-managed super funds. Now, from 2004 to 2020, that's a sizable increase. It's around about a 600% increase, which I find absolutely phenomenal. And here's the first thing is that for any of us who are professionals working in this industry, we're working in an ever-growing industry. Now notice, in 2008, 2009, in between there was a GFC, but self-managed super funds continue to grow. And that's really crucial because if we are going to work as a professional somewhere, whether it's accounting, law, whether it's an engineer, we want to make sure that that we're sitting in an area that continues to grow, irrespective of whether the economy goes up and down. And having been in self-managed super funds since 1993, when the Superannuation Industry Supervision Bill came out and I made submissions on it, I've seen self-managed super funds grow quite considerably, and they will continue to do so. With the budget measures, with the increase in the numbers in a self-managed super fund, it's a lay down bazaar. So let's get back to the story. Industry and retail funds are pretty hard hit inside these funds, and I think that's a great thing. Personally, I believe that if we can get our children inside our fund, it's a very inexpensive process. If the main members of the fund, mum and dad, are sitting in there, they pay all the fees, the audit fees, and how good is that? That if you've had 3 years, this starts from the 1st of July 2019, if you've had 3 years of consistent compliance and lodgement of your tax return, so there hasn't been any qualification made by an auditor, you only need to have your audit done every 3 years. Now, of course, the SMSF auditors are up in arms, but look, I love you guys, but let's face it, if you've got a good, strong, plain vanilla self-managed superannuation fund, you're not doing anything dodgy, really, why should you have it audited, a compliance audit, each and every year? The administrators are there, and of course it's the trustees. Again, this is a tick for people to comply, and I think that self-compliance, that self-assessment is a great thing. So again, that will reduce the costs of our audits, that reduce the cost of the self-managed super fund. The other one is if mum and dad are paying all the fees, the administration fees, the audit fees, the investment management fees, then effectively the children can come in, they can contribute to super, they can salary sacrifice up to $25,000, and I'm going to talk to you a little about family trusts and that a little bit later on. They can go above that, and really for me the $25,000 cap, particularly now we've got the low to middle income offset, is not a big issue. I'd rather go in and go over super, provided it's allowed. Well, it's allowed, but we sort of make sure that it fits in strategically into our overall family group tax planning. Is pretty important. So effectively what we're going to start to see is more and more the younger brigade with switched on advisors, and I just want to draw a little map here for you so you can actually understand where we are. I'm just going to go off camera here. So again, strategy is absolutely crucial. That's why I'm here at the moment. Remember, our value to our client, our value to ourselves is in strategy, not investment. And more importantly, if you're solely delivering administration, your value to the client is to deliver automated, as best as possible, low-cost administration over a period of time. We've already seen it since I first started in the 1990s, administration fees have at least halved or gone down by 40 or 50, even more than 50%, sometimes 60 or 70%, and that will continue on the downward spiral as Class Super, BGL and Super Concepts and other admin platforms start to get a lot more data feeds and make everything a lot more automated. So let me just draw a little map here. This is a little bell curve, and if you've been to one of my sessions, you've probably seen me do this before. Now, the family super idea, the measures that are coming out of the budget, let me just put a little map there for you, and I'll bust this up into 4. So what we've got here is, and I'll just take this out a little bit further. So I've got 1, 2, 3, 4, 5 sectors. And with any strategy, with any new idea or new service, new product, it goes through this marketing phase. So for example, if we have a look at it, when the iPhone first came out, that really changed in 2007, fundamentally changed the way we dealt with our phone. Prior to that, if you remember the old Nokias, we effectively just used the Nokia as a handset. Smarter ones had Blackberries where they could do emails, but effectively when the iPhone came out, we've got the innovators there. The innovators were essentially people who used to do apps for the iPhone. We would then have the early majority, oh sorry, not the early majority, we would have there the early adopters, so silly me, early adopters. We have the early majority, late majority, and of course the laggards. So in terms of the iPhone, I had the iPhone, I think I got it in 2008. So I would have been in the early adopters. I tend to get something. In fact, if you have a look at the moment, this whole presentation is done on a Mevo, which is a very small little camera that takes 16 different angles, and effectively we can stream live to YouTube or Facebook or alternatively Vimeo or Twitter. So again, any new technology, I pick it up because I pride myself as an early adopter. Of course, then, once the early adopters, you'll find a product will go into the early majority. So for the iPhone, that would be people who picked it up around about 2009 up to 2012. After that, smartphones became ubiquitous. Samsung, Huawei, there's a whole lot of them. So that's when the late majority would pick up a smartphone. And have a look at how many of you have got smartphones. Look around if you're in a conference room at the moment, see how many people have actually got smartphones. Most of them are fairly ubiquitous. Now, of course, there's always the laggards, and that would be people such as my mother who can't really adapt to technology, don't like change, and of course, they'll still use their Nokia or a substitute that is available. Now, unfortunately, my mum's had to get rid of her Nokia because Telstra don't support that technology anymore. So again, through a service, it's the same thing. So a strategy, for example, the transitional retirement income stream, which they knocked out on the 1st of July 2017. When I mean knocked out, there's a whole lot of strategies around that still. In fact, I'll be looking in that a couple of things just to give you a bit of a heads up. On between the 4th and also the 7th of June in Sydney, I'm doing my 4-day accreditation course. And that, for those of you in self-managed super funds, we look at this. This book is your Bible. There's 2,800 pages of legislation. Of course, after last night's budget, there's another 40 pages there. 2,800 pages of legislation. If you are a self-managed super fund advisor, you're providing advice under the Corporations Act. There's 5 skills competency standards there. Those skills competency standards require you to read, understand and apply the law, including the trust deeds. If you don't know your way around this, then you're putting yourself at risk when it comes around to AFCA. For those of you, there's still about 10 seats left, so make sure if you are able to come along to that 4-day training session. I'm only doing it once, mainly because it's a big swag of time, so I'm doing it once only. In the future, I'll be doing short courses for that. But anyway, if we go through and have a look at the transitional retirement income stream, which was really, we basically put money into super, we go on, put it into our pension, we take a transitional retirement income stream, sometimes even recontribute it back or salary sacrifice and just do this big washing machine and effectively dampen down our tax, which was a great strategy. And so really what happened is that strategy really became available once the transitional retirement income stream really started to hit its force, which was in 2005. So that strategy was out in 2005 and effectively it then jumped in the early majority, jumped in the late majority, and of course there's some people who don't even understand what the strategy is now. But it's been knocked out and effectively it's all gone. But it depends, where were you? When did you first apply that transitional retirement income stream and salary sacrificing? Where were you? Were you here in the early majority, which would have been around about 2010 to 2012, or really were you still doing it, just got onto it around 2014, 2015? Now, of course, I would have been right at the front. I was innovating that, and that's essentially why you're here today, is because I'm an innovator when it comes around to strategies. People say I'm out on the edge, but let's face it, you want me out on the edge. You want me to innovate, come with strategies, because I'm presuming there most of you are working in this area here. Because if you're working in this area here, that's where all the money comes in. Because if you've got new strategies, new ideas that are going to the client, and you're an early adopter of those strategies, you can see here, that's when the value of that strategy is its highest. Of course, if you're doing a strategy when it's down here, effectively there's really no value of the strategy, because the client, once it gets about here, the client can find out themselves from the internet. More importantly, they can just go out to any accountant, administrator, anyone, everyone's talking about it. It even gets in the fin review, etc. So our value is here, being in the strategy. Now, if you're doing retail or industry super funds as an advisor and focusing on that, you are well and truly in the laggard. You effectively see now all the banks are selling their wealth units, AMP's been hauled through the coals, there's no commission, and now there's no exit fees from the 1st of July 2019. So it now means that a lot of these retail industry fund products are getting smashed. Actually, let me just jump back as well. No exit fees. Importantly, this is another important thing as we go down the family super fund. So park this, I'm only going to talk about it once, is that if there is an account which has been idle for 13 months and is less than $6,000, an industry or retail fund will be forced to go to the tax office and transfer that money into the tax office. Now, attached to that account generally will be identification, tax file number, so on, and then the tax office will then chase down that person, asking them where they want to put their super in. Of course, where's it going to be? The Family Superannuation Fund, or the Family SMSF. The other side there is also insurances. While I'm here, again, if you've got an inactive account, more importantly, if you're under age 25 or your account balance is less than 6,000, previously insurance was always on an opt-out basis. Now it's going to be an opt-in, so that industry and retail funds are going to have to get their administration processes up and running and then start to go out and tell people that, look, you've got until within 6 to 9 months, you've got to go out and you've got to be in a position of opting in for life insurance. Now, by taking all that younger brigade out of insurance, because most of them won't go for it, effectively means that the pooled premiums for the other members are going to increase. So suddenly it's going to mean an increase in insurances. So again, I start to see with this increase in the ability to do family super, get 6 members into the fund, more penalties on insurances, and making low balances now being forced into the tax office and looking for a home elsewhere, that's starting to really going to shake up the industry and retail funds, which is good because again, that means that for us, this has propensity, capacity, and an ability to grow. Even if there's a GFC, we're going to start to see it grow up. And for us, our theme, our thematic, is going to be around the Family SMSF. So you're going to start to see me start to switch over the next year to give a lot more talks, a lot more ideas around estate planning, tax minimisation, utilising super and also the family trust, and starting to build these family SMSFs. For those of you who deal with small businesses, the Family SMSF will sit alongside the Family Trust, and of course that will then sit alongside the Testamentary Trust. And while I'm there, they're also looking at ensuring in the rules in relation to Testamentary Trusts that only assets from the testamentary trust from the estate can find their way into the testamentary trust in order to access the minor provisions. Now, of course, you can put your super in, but really, if you're looking at tax for minors, you shouldn't be using a testamentary trust because any child up to age 25 should be getting an income stream from a self-managed superannuation fund. That is an early adopter strategy rather than a testamentary trust. So we've got to be very careful with estate planning. Again, just as an aside there, next week I'm doing a session on the 16th of May for Cashwise, or Simon Maker Cashwise down in Canberra. It's going to be streamed for only $95, but I've got 2 solid sections on one, the budget, latest strategies around SMSFs, and also estate planning. So I'll be talking for about 3.5 hours, a lot of these strategies, and I would have had a few days to bring a lot of this stuff in and starting to meld it. So if you really want to know a lot about family super, a lot of strategies around that, how to not worry about the T-bar, how to really put in place great estate planning, both testamentary trusts and pensions, then make sure you sign up for that. It's only $95 to stream it into your office, so everyone does a great training session, and just simply look for the times that I'm on. Anyway, what we're doing here is family super is effectively, for me, is an early adoption strategy. If we have a look at a self-managed super fund, most people have got self-managed super funds, certainly baby boomers. If you have a look at the statistics that come out from the tax office, all the baby boomers, there's hardly anyone setting up a self-managed super fund if you're already baby boomer. War generation, all done and gone. So the major people setting up self-managed super funds are effectively those who are under age 50. Not many for those people under age 35, so the bulk of setups, which is around about 15 to 20,000 each year, is really between ages 35 and 50, and I want to come back to that a little bit later on. But self-managed super funds, everyone knows about it. You hear about it all the time, parties, even they talk about it on Channel 9 and all that. Effectively, self-managed super funds are pretty ubiquitous. So even the late majority understands it. But, and here's the thing, no one really understands the family super fund. That is the area that we all need to dive into, start to build strategies for it, upgrade our deeds, upgrade our strategies to start to work out how it fits in the whole scheme of things. So let's start building that, starting to bring in a lot of the ideas out of the budget and building a family super fund for you. So first off, what are the benefits of a family superannuation fund? Let me just get rid of some of this stuff for us. As you can see, this is all pretty well. If you've got a question while this webinar is going on, please feel free just to write it in the box, and one of our legal team will effectively coming back to you. As an aside, for those of you who have searched I Love SMSF, you'll find that the site is undergoing construction at the moment and will be released in the next 2 to 3 weeks. And there'll be a whole lot of videos, a whole lot of strategies. In fact, I've done more than 50 videos that will go onto our SMSF TV section of that site. Also, for those of you who are looking at doing the course, I've got an online course that will be available there, again with a lot of videos supporting that. I've done more than 30 videos that really correlate to each and every one of those chapters. So there's a lot of stuff coming down the track. We've got it all there, so watch out for it. So let's start off and have a look at our typical session. So I normally have a self-managed super fund. One thing I have noticed, and congratulations to all of you, corporate trustees are effectively now 60% of self-managed super funds have corporate trustees. So effectively, from that perspective, if we can, sorry, that's just my phone going off. Someone's obviously coming in with some really great strategies. Hopefully that's not the tax office, so I apologise for that. So if we have a look at a family self-managed super fund, what we can have is, as I said, up to 6 members. So 1, 2, 3, 4, 5, 6. Now, we can become a member of a fund, provided our deed allows, as soon as our hearts start beating. On death, our membership doesn't cease necessarily depending on the trust deed. The trust deed I'm about to write will ensure that your benefits or your membership carries on until the estate or your SMSF estate is effectively liquidated or wound up. So we've got that period of time to become a member of the fund. We could have 3 generations inside a family SMSF if we want. So we could have grandpa, grandma, their children, and also their grandchildren if they so desire. So we can start to build that. Now notice how when we talk about family and we start considering family SMSF, the issue we've got to look at for our clients is it bloodline or is it not bloodline? So that means when we start to build a membership inside our family SMSF governing rules or trust deed, what we need to do is effectively we have to work out, well, is it going to be bloodline or are we going to allow in-laws in? My belief is that if you are going to build this, you stick to bloodline. For example, ask your clients a couple of things you might want to go down this track, and this is an easy way to introduce family SMSFs to them, is asking a client what's the most important things in their life right now. Ask them to write that down. Generally, a secure income. The second one is, and not in this order, is health. And the third one quite often, or the third one definitely in that top 3 is always family. So family really appears and looms large for most of your clients as the most important thing in their life. Hence, why we wrap this around family, this family SMSF, as opposed to what you're going to hear me call from now on is a common SMSF. So that if you're not embellishing your SMSF with these family hues, effectively your client has just got a common SMSF. And for people with $1 million or more in a common SMSF and not being told about a family SMSF, I think ultimately if they find out, as the word spreads, remember it will go to early majority and late majority, they'll start to get a little bit upset. So we can have 6 members in there. Obviously, we've got a corporate trustee. They all need to be directors, which seems to me A-OK. So all directors, if they're the grandchildren, remember they're under 18, then their parents, who may or may not be in the fund, will stand in place as a replacement director for those children. And effectively, if they're inside the fund, will act in a way on behalf of not only themselves, their own balance in the fund, but also their children as well, those under 18. So again, the trustee laws of the State Trustee Acts require you to act on behalf of the beneficiaries, as does the SIS Act as well. Now, of course, everyone's coming out, and you'll always hear naysayers. Whenever there is a new opportunity, whenever you're not pushing the boundaries, but whenever you're coming up with a new concept like a family SMSF, you're an early adopter, there's always a lot of people going to say, well, no, it's too hard. Oh, no, there's too much administration. Or no, you can't do this. You want that. Because remember, the people who say you can't do that are in the late majority. A lot of them are probably laggards, or in 4 or 5 years' time, once you've already got your clients set up and you're starting to poach other people's clients, that's when they'll have an aha moment, and that'll be like, oh gosh, we've got family super. Now, I can tell you this because I remember introducing, and this is absolutely crucial, way back in the late 2000s, and when I mean that, about 2007, 2008, I could see in going through the legislation. For those of you, I have to get the legislation out because this is my Bible. I actually have it next to me in bed. Section 59 of the SIS Act and also Regulation 617A talk about binding death benefit nominations, but the Commissioner and also the law and also the cases show that those provisions don't apply to self-managed super funds. We have to focus in on the governing rules and the trustee. And that's important because there's a limitation, and there's been a number of cases where people have stuffed up, thought they were doing a binding nomination, but then found that really there need to be procedures and set in place inside the trustee, which they didn't meet. Anyway, that's for estate planning. Watch me at Simon's thing next week, or certainly come to our SMSF Specialist Advisor Accreditation course. But notwithstanding that, at that time I figured I was dealing a lot with advisors who had clients in regional areas. They were putting farms inside self-managed super funds. They were putting business property in there. Their kids were working in the business, so on and so forth. So they needed a succession plan inside their self-managed super fund. What would happen if mum or dad died yesterday? And if there's an asset in there that the client wants to go specifically to a child, and it's protected, the beautiful thing about this is it's protected by Commonwealth law, the Superannuation Industry Supervision Act. We transfer it outside of here into the estate. Even though it goes into testamentary trust, it's going to be attacked under each state's Family Provisions or Dependents Act. So I love dealing directly from here if possible. That's why I said before that if you've got a child who's under 25, you don't pass their super into an estate and look at testamentary trust because it could be challenged. You're better off just paying an income stream from here. And if you pay an income stream, under all those child provisions, if you pay an income stream, the maximum tax they're going to pay is virtually, if they receive up to $40,000, is going to be virtually nil. So we want to make sure we look after there, particularly from the children. So with the family SMSF, we've got the directors there. As I said, it's a new idea. I was telling you about the story. There you go. I was getting too excited and jumped around. That disposition of a specific asset down to individuals is unchallengeable. Have a look at Donovan, Katz and Grossman, unchallengeable. So the idea there is we needed something, not a binding death benefit nomination, which simply says, well, such and such a percentage is to go to this child, such and such is to go to this, or to go to my spouse. It doesn't work. And the same with auto reversionaries. We need to get specific. So what it is, I came up with the idea SMSF will, which effectively is something that's easy to understand for our clients. And that's why we need to concept. If you went and you asked your client, what is a family SMSF or family super fund, I can tell you in a heartbeat they're going to know. They're going to say, well, hold on, this is a fund for my family. And then they should start being asking, how many members of my family can get in? It's something they grasp easily. SMSF will, what does that mean to you? It's something that's easy to grasp. It's a will that's made inside the SIS Act that deals with the disposition of assets either to the estate or to dependents, and specific assets if you want. You can also talk about who's to be appointed as trustees, who's to be the investment manager, a whole lot of other things that's separate from a day. Anyway, the story there is, when I first came out with the idea of SMSF will, and again, it's just a set of directions that the member of the fund gives to the trustee, and it binds the current and future trustees as to what happens in the event of their death. Everyone's saying, well, no, you can't do this. And these are all the lawyers, the naysayers. Lawyers, no, you can't do this because you can't call it a will, blah, 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 and all that sort of stuff. And funnily enough, the same lawyers, and I remember being at a SPA or SMSF Professional Association conference, people saying, no, you can't do that. 3 years later, those lawyers now, who in the early majority, started to talk about SMSF wills, so it's quite ubiquitous. In fact, that gives us another idea that when we do a family SMSF, we need to have at the back of it an SMSF will. Again, another strategy, another idea, another way to go back to your client. Anyway, getting back to this, we've got a family SMSF and our company. And of course, the big thing is, oh no, you can't do that. It's too much administration. Or there'll be too much. What happens if the 4 kids all start to gang up on mum and dad? Well, seriously, that's just a crazy talk. That's like saying, look, I'm going to take over a company, effectively, and I hold 19% of the shares. That means now I've got equivalent vote to someone who's got 40% of the shares. It doesn't work that way. You can put inside your company exactly the same measures that directors, when they come round to look at votes, they get exactly the same number of votes as is sitting in their account balance, or the account balance that they act as a replacement director for. Simple, easy to measure. But then you can opt out of that. So you can have a default mechanism where each director has 1 vote. You can have a chairman with a casting vote. You can have everyone that is based on their member account balance or their replacement director. But it's up to you. You're the driver of the strategy, sitting down with a client saying, well, which one would you prefer? And once you do that, you then put in a governing rule, and that now sets inside that fund until it is subsequently changed. And of course, when you put that governing rule, you say exactly how that specific rule is to be changed. Likewise, if you're really old school, and here I'm just going to say is you shouldn't have individual trustees. Listen to that. You shouldn't have individual trustees. Effectively, Section 19 of the SIS Act says that a fund is a regulated fund if it has a trustee, so that's okay. If it's a regulated fund, then Section 45 of the SIS Act says if it's a complying regulated fund, then it's enabled to get all the super concessions. Now, here's the problem. Section 19.3 says there's only 2 conditions for a fund to be regulated. First off is it's got a corporate trustee, so that's okay. So the constitutional power where the government has power to look after a company is available for a family super fund, a SMSF. So if you've got a company, then you're A-OK, you're always going to get the tax concessions. Whether you comply or not, that's a separate issue. But, and here's the big but, if you've got individual trustees, the primary purpose of that fund is to pay lump sums, to pay pensions. Sorry, I got that one wrong. I'm jumping ahead of myself. Is to pay pensions, and effectively old age pensions. So if you've got in the set of governing rules that you've got an ability to pay a disability pension, a temporary incapacity pension, which is really important, a transition to retirement income stream, or more importantly, don't even want to pay a pension, you want to leave your money inside your accumulation account and not pay it out as a pension, which is going to become in force. Again, that's another early adoption strategy I'll be looking at in the future. As we go down that track, effectively, it means we may not be able to be regulated. There's certainly a problem, and I'd put a big question mark over it. So again, we want to go to the corporate trustee. The problem is if we're not regulated, this now becomes a trust which doesn't distribute and will be taxed at 47% on its income each and every year. So don't go there. Anyway, corporate trustee, I'm assuming most of it, family super fund, proportional voting system up in the directors. One other thing that you also need to look at, and I'll be building this again in my new family SMSF documents, which are available on the 1st of October of this year, so it gives us plenty of lead up to 2019, is that when someone dies, their benefit, their executor, whoever it is, will be automatically appointed, subject of course, I've got some checks and balances in there because of the Corporations Act, will be automatically appointed as their director, and they are the only ones that can vote in terms of the disposition of their benefits. So that makes it available. So if you've got an SMSF will in place, it's really this person, this executor, who is going to control the process. That gets around the problems we saw in Donovan and Katz and Grossman. If you haven't got that in place, well, gosh, you're really having big problems. Remember, Section 55(1) in AFCA, you're going to have little problems there. So we've got our family super fund, we've got different generations, and in here, for example, we could have our pension members, and then we could have our accumulation members. And of course our income stream members, if they're over the pension transfer balance, may also have an accumulation balance as well. So we could end up quite easily inside this fund, we could end up with maybe 1 or 2 pensions plus an accumulation account. We could end up with 10 separate accounts. Now another thing that was really important that was introduced in the budget, and I think this is a great one, is that, and this is again another area where I believe we're really, for those who are doing family SMSFs as opposed to common, you're going to have to upgrade your D between now and 30 June 2019, that we need to put in a strategy, a retirement incomes policy inside that fund. So retirement incomes policy is effectively how we're going to manage this fund in order to maximise the retirement incomes for our members, which seems to me okay. Now here's the thing, and I think this is where industry and retail funds are going to have a problem. These guys are already in a retirement income. So their investment strategy, would I be right in saying this, their investment strategy, their already retirement income, should be completely different from some of these younger members who might be 20, who might be 15, who might be 40 or 45. Because this group here wants to maximise their retirement income. These guys here want to make sure they have capital protection, or they have the best drawdown that is possible. Now you will not be able to put over a balanced portfolio over all this. A good SMSF investment strategist, to me, will have an ability to actually start to build separate investment strategies for each and every one of those superannuation interests. In fact, and you'll see, for those who really want to get into that deep dive, that detail, again, come to that 4-day course with me, because we'll be looking at building separate investment strategies for every superannuation interest. So remember here, they might have, for example, a tax-free income stream. They might have a taxable account-based pension, and they might also have an accumulation account. 3 separate interests, to me 3 different investment strategies, and we do that for the purpose of maximising our tax-free pension, and of course also once we've already been tested, we're not going to be tested under T-bar again through those pensions. So we can have a whole lot of different investment strategies. And here's a question that I put to you and your administrators is, has BGL, has Class, and has Super Concepts, or whatever software you're using, has that got the capacity to start to split apart this into separate investment strategies? Because at the end of the day, once I do that, I'm turning my fund into truly what is a wrap account. Now, it's funny that we're going back to the future, that if we have a look at the big measure for the retail industry funds was to allow members in there to start to pick their own investments, hence their argument, which was always facetious anyway, that when that person had the ability to pick, and they were only one person only, that effectively it was a de facto SMSF. And some of them actually came out of it, and the ASIC came and knocked on their hand and said, look, that's not okay. But we can take from there is there should be an ability for pooling over 1 or 2 members or separate investment strategies. Now, tax-wise, when we come round to having a look at a Section 295 480, when we start to look at segregated current pension assets, if someone is over that 1.6 million, then we can't use segregation there. But it doesn't matter. We still want to do segregation from an investment strategy from a SIS perspective, not a tax perspective. Again, start to consider this family account as a wrap account. And certainly know that my parents' one, although I'm not in there, my brothers have quite separate identifiable investments in each and every one of their accounts. They've got separate investment strategies. Mum and dad in cash, they're in specific investments. So again, this is an early adoption strategy that fits in with our family SMSF. So we start to move along this line and get our idea. That means that we have to do SMSF wills for each and every member. Auto reversionary pensions through there. Watch those testamentary trusts, as I say. If you're passing your super over into your estate, don't get it muddied up with the other assets. Put it into what we call a testamentary trust, which only has super. And I call that a super proceeds trust or an SMSF proceeds trust. So we can start to build that for estate planning. More on that a little bit later. Again, we're starting to build these ideas. Now, here's one thing. Pension members, again, they've been really well looked after if they're investing in Australian stocks. Do you know, I went back and had a look at the underlying investments of self-managed super funds around about 15 years ago, and a lot of SMSFs had invested in unit trusts or managed funds, and that's mainly because financial planners had talked them into going into managed funds. Now, virtually no unit trusts or managed funds investments. In fact, it's dropped right down, and instead what's picked up is being managed investment schemes or listed investment companies. And why is that? Because of the franking credits. Instead of getting the distributions coming through each year and being tax-free, now what we've got is the distributions coming through and franking credits, which they get a refund from the government. Now, of course, that's unsustainable to have a fund that doesn't pay tax and get a tax refund. When I go overseas to Singapore, Hong Kong, the US or UK, telling that to people, they do not believe it. How is it possible you're not paying tax in retirement, you're over age 60, you're receiving tax-free income, and you get a tax refund from the government? Again, Labor's put it on there, but at some point in time it's going to come down the track. We need to start to be advanced. Why? Because we're strategists, we're early adopters, we know exactly what we want to do. So from that perspective, what we're going to do is effectively put in place systems. You see, if we've got these other members of the fund, and let me play around here. So we've got our family trust, for example. And again, we've got a corporate as a family trust, can't be the same company. And what we have is distributions. So that goes down to our children. One of the things with the new low to middle income earner tax offset, that $540 is available, and that's available this year. So make sure you do your trust distributions this year to anyone earning up to $90,000. So if that goes to our kids coming out here, even though when I talk about kids, I'm also talking adult children, grandkids. If that goes out to our children up to $90,000, then effectively they get a $540 tax offset. Now that only applies once you've lodged your return. So you lodge your return, tax office does their thing, here you go, $540 back. Great thing, great idea for all of you accountants out there. Get this in place by 30 June 2018 because it applies now if it gets through law, of course, if it gets through both Houses of Parliament. But what I'm saying here is if we are employed, if our children are employed by the family trust, then of course we can put 25k into that fund. And of course we can go above that, but I'm just going to stick to basics at the moment. We want to use our cap limit, our excess concessional cap, make sure we stay under 25. Now, if they're not employed by us, they can still get a distribution, and that distribution, they can still kick in up to 25. Now, of course, if they're working somewhere else, and again, this legislation shows if they work somewhere else, they still can get a personal tax deduction, but what they have to do is they have to make sure they take into account their employer's SGC, and hopefully, this makes sense to me, is that if you've got a family super fund, all their SGC will be going in here anyway, so they know at the end of the day, their accountant, their administrator would tell them, well, you've got this amount capacity, you distribute down before the 30th of June, and then that goes into our self-managed super fund. Contributions have to be made and paid. So if it's a distribution, it has to go down and in before 30 June. You can't simply do it by way of a note or a bookkeeping entry, although you can use promissory notes. Again, very sophisticated, early adopter scheme inside the legislation, Commissioner's rulings on contributions 2009/1, but something for our advanced course. So, but if we've got 3 or 4 kids, that's $100,000 that can be cleared out of assessable income into the fund. Now, here's the deal. The money goes in, it's not subject to contributions tax. Only the industry and retail funds use that as what I believe is a rip-off, taking 15% straight off. Remember, that money that goes in as tax deductible is a concessional contribution, is included in the funds, the family SMSF's assessable income. Now, of course, we then take deductions, and that could be interest deductions, so on and so forth. A couple of little things just around that one. First off is, if we have a distribution and we're claiming a personal deduction, in order to marry up this and also this, there's going to be, in the form this year, you'll find that there's actually a tick box that if you're claiming a personal tax deduction, which is available from the 1st of July 18, you're paying a personal tax deduction, you have to tick that you've notified the trustee of the fund, because the trustee of the fund has to include it in its, remember, it's assessable income under section, does anyone know what section? Section 295-160 of the Income Tax Assessment Act. So we include it in our assessable income. The other thing is the tax office is going to come up and send out information, notification to people that you must put that notification. If you don't put that notification in, effectively you don't get that tax deduction. So the money goes in, it's assessable, take off deductions. Just as an aside, if you've got land inside the fund, which you're land banking, if it's not, hasn't got a house on it, or alternatively it's not to be using for primary deduction, any expenses in relation to that land is non-deductible. Again, a tightening up of the screws applies there, and it will also apply to land banking outside a family trust. So be really careful of that one. So it goes in as 25, assume that there's no expenses, that $25,000 goes in, then effectively it's going to be included in the fund's assessable income. So let's say we've got 4 25s going in there. All our kids, they've all piled their money into their super fund from the family trust. That's $100,000 that's now going into the family SMSF, which is great. So if there's $100,000, that means de facto there's going to be a $15,000 tax liability in that fund, which effectively is the inclusion of those contributions going in. Now, of course, ordinarily you'd have to fork that out, but if you've got these guys in here and they've got imputation credits, those imputation credits effectively can be used to reduce the tax liability. Now, one other thing is, which generally has been used by the larger funds, is if these pension members want to, they can sell those imputation credits. So these members here, monies can be taken from their balance over to the pension members for the sale. So it's an internal bookkeeping entry. So they still get full value for their imputation credits, but it's sold internally because these guys are using it. And let's face it, if that measure comes in, isn't it better to use it rather than lose it? It just seems to me to make sense. When I first heard the measure, I thought, well, this is exactly what we do. Then they come out of the family super fund and we're in a really good position. So if we have a look at a lot of these ideas that are coming up for us, the reduction in that low to middle tax offset, which is a good idea. Family trust is still important. Utilising self-managed super funds, or not a common fund but a family SMSF, it really starts to put everything together. And starting to get more and more people inside that SMSF is your responsibility, our responsibility, and we want to be those early adopters going out and talking to our clients about family SMSFs before they hear about it from someone else. And we want to start to say, well, hold on, we've got something to go back to our clients and say, well, hold on, you've got a common SMSF, which was available before, but now the government's changed the legislation, and we can start to build that up to the 1st of July 2019. And once we start to open up more members, that means it's not just one strategy, there's now a whole raft of strategies there, all for the benefit of the family, all to reduce the tax payable by the group, the family group, and more importantly, to maximise the wealth of not only this generation, the next generation, and the generation thereafter. Because once you set up one of these family SMSFs, they do not go until they die. But DIY and common SMSFs with one member, they die as soon as the member dies. And what a shame, how ridiculous that is. And of course, there's a whole lot of other issues that we can start to pull in there, a lot of strategies. And again, if you're really interested, make sure you come along to my 4-day course on between June the 4th and 7th. Otherwise, I'll be available next week. You'll be able to tap in and get a bit longer spiel from me. And of course, there's 40 videos coming down the track anyway. So that's my bit of a budget update, strategies, some ideas there. I'm going to start pulling apart some other ideas, particularly around the older Australians, where we do have older members in there. Obviously, there's a switch over. One of the things that changed in the budget was that in our final year, once we're over age 65, if we're not working, we can still make a $100,000 contribution into super. But for me, if you're old, you're up to 75, work through this family trust and keep on contributing. The more we contribute, the better off, because we're going to have to, if someone lives to 90, 95, we're going to have to make sure we've got enough capital in there to last. Anyway, it's Grant Abbott. A couple of things. In the next couple of weeks, we'll be launching I Love SMSF, so look out for that. I'll be coming in with a whole lot of strategies. Look out for a whole lot of our videos. And remember, where are you? Are you one of the early adopters, or are you one of the laggards? And I'm presuming most of you here are really about strategy. Strategy wins out every time. How can we, if simply using a super fund over a period of time is going to reduce our tax liability, increase our underlying wealth, as opposed to people who are using family trusts? So isn't it incumbent upon us, that's a guaranteed strategy, a gift from the client, to increase our client's wealth? Anyway, it's Grant Abbott, signing off.